Hi, good evening to all. Today we are going to look at an important topic of banking law and practice. Under this, we are going to look at the quantitative method of credit control. First of all, we look at what the credit control means. It is an important tool of the monetary policy used by RBI to control the demand and supply of money and flow of credit in an economy. Credit control is a tool that is used by RBI to control the demand and the supply of the money circulation and the flow of the credit in our economy. RBI keeps the control over the credit created by commercial banks. Commercial banks created a lot of credit for the purpose of or the development of our economy. That the credit controls by the RBI. Next is the quantitative method. Quantitative method are as follows. The first one is the bank rate. It is the rate of interest at which a central bank lends funds to commercial banks. It is the interest rate through which the commercial banks lends funds to commercial RBI lends funds to commercial banks. During excess demand or inflationary cap, central bank increases bank rate. During inflation period, central bank increases the bank rate. Borrowings become costly and commercial banks borrow less from central bank because the bank rate increases. That's why commercial banks borrow less funds from the central bank. During deflationary cap, central bank decreases the bank rate. During deflation period, central bank decreases its bank rate. It is cheap to borrow now from the central bank or the part of the commercial banks, which in turn the commercial banks also decreases their lending rates. And that's why now commercial banks borrow now more the funds from the central bank because the bank rate decreases. As well, commercial banks also now provide cheaper lending rates now to the public. Next is open market operations, which means buying and selling of bonds and shares by RBI is open market. Funds and the shares the buying and the selling procedure is done by RBI to buy the bonds and the shares is called open market. It is also called buying and selling of government security by the central bank from the public and the commercial banks. This function of the buying and the selling has done by the RBI through public sector banks and the commercial banks. Next is the cash reserve ratio. It's also called as the CRR. It is the ratio of a bank deposits the commercial bank has to keep with the central bank. Commercial bank has to keep a certain ratio of deposits with the central bank. At the time of inflation, the RBI increases the rate of CRR. Similarly, at the time of deflation, RBI decreases the rate of CRR. During inflation period, RBI increases CRR. Similarly, during the period of deflation, RBI decreases the CRR. Next, the statutory liquidity ratio, shortly called as SLR. Every bank is required to maintain a fixed percentage of its assets in the form of cash or other liquid assets are called SLR. Every commercial banks have to keep a certain percentage of its assets cash, gold or other the liquid assets is called the statutory liquidity ratio. At the time of inflation, the RBI increases the SLR. Similarly, at the time of deflation, RBI decreases the rate of SLR. This point is similar to CRR. Next, the repo rate is the rate at which the RBI lends money to the commercial banks in the event of any shortfall of funds. If a commercial banks need the money for the emergency situation, that time they approach to RBI. That time RBI provides funds to the commercial banks. That time they put the rate of interest, that is the repo rate. Repo rate is used by monetary authorities to control inflation. The main function of a repo rate is to control the inflation. That's why they provide funds to commercial banks. A reverse repo rate is the rate at which the RBI borrow funds from the commercial banks in the country. It is the reverse procedure of the repo rate. In case repo rate RBI provide funds to the commercial banks, whereas as reverse repo rate RBI borrows funds from the commercial banks. It is the main difference between repo rate and the reverse repo rate. In other words, it is the rate at which commercial banks park their excess money with the RBI, usually for short term. If commercial banks have the excess money, that money has to deposit, that money will go to the RBI for the short term period. It is also called reverse repo rate. Thank you. We will see you again with another session. Until then, stay tuned, stay blessed. Bye.